Joining us now, Adam Bold, founder and CEO of the Mutual Fund Store, and in Chicago. Thanks for sending the Cubs to Citi Field, Jeff Lehman, Chief Investment Officer with BKD Wealth Advisors. Jeff got up an hour earlier. We'll let him start. Jeff, where's this market headed?
Well, the interesting thing, we've had the start to another earnings season where most companies are beating expectations by a fair amount. We've had a fantastic rally that continues here over the last year, but I think it's justified. If you look at the improving corporate fundamentals, they're getting a lot of mileage out of lean cost structures, improved productivity, and the market should move higher if we continue to beat expectations as we have.
I talked to a lot of people, and Jeff, and half of them say this market's come too far. The other half say, you know what, that was a panic low a year ago, and you can't really, say it's come too far based on that low because that was really an outlier. You agree with that?
I really do. I think that this would be a real difficult thing for any investor to do today, but if you just try to forget the path of where we've been and look at valuations as they stand today, with the market on 2010 estimates at about 16 times and companies generally beating earnings estimates, that's, in our view, a fairly valued market, and we have come a long way. It leaves us susceptible for the sorts of short-term minor declines like we had in mid-January through early February, but we feel pretty good about the valuation of the market at this juncture.
Adam, I know you're also relatively optimistic, but you're worried about what retail investors are doing right now.
Yeah, I mean, what I'm starting to see is that the retail investor is all of a sudden starting to buy into the fact that this market is for real. They didn't buy in at 7,000 or 8,000 or 9,000. Now at 11,000, finally, like, they're okay. But what we've really seen that really concerns me is the fact that over the last 12 months, we've seen $500 billion in net flows into mutual funds. Of that, more than $400 billion went into bond funds. And so, people are buying bond funds at the exact moment that interest rates are almost zero, where there's what's the upside potential? I mean, if interest rates go up, and I'm not saying they're going to go up next month or the month, but eventually they've got to come off the bottom, and they're doing that the same behavior, just like they bought tech stocks in 2000 after the big run in '99. They're buying bonds after they've.
Would you recommend they buy equities right now?
Yeah,
at this point?
I think stocks look very good, and we're starting to see some of that money repatriate back into the market. And I do agree with what Mark said, and that is we were poised for a global financial collapse. That didn't happen, and so we got that big bounce. And while we have come a long way from 6,600 on the Dow, we were at 14,400. So I mean, we're still way off the highs. So there's still a lot of opportunity to the upside.
Adam, Jeff, thank you both very much. Appreciate you sharing your thoughts with us.